Theoretical definitions in advanced accounting dictate exactly how you compute and present your final answers. They are the parameters that govern every practical computation. The rules established in the official curriculum materials form the foundation for the examiner's grading rubric. Misinterpreting a foundational definition triggers a cascade of errors through a practical exam question, resulting in significant mark deductions as the computation progresses. Rounding figures on a Schedule III balance sheet is a strict statutory requirement determined by a company's total income. It is never a matter of personal preference. This flowchart shows the two paths for splitting total income thresholds. For companies reporting a total income of less than 100 crore rupees, the rules allow you to round off to the nearest hundreds, thousands, lakhs, or millions. If the total income reaches 100 crores or more, your options are restricted. You must round to the nearest lakhs, millions, or crores. If a company has 105 crores in income, rounding its balance sheet to the nearest thousands violates the Schedule III threshold. Because 105 crores crosses the upper threshold, thousands is no longer an allowed metric. To maintain compliance, you must select the correct unit of measurement and apply it uniformly across the entire financial statement. Companies often need to reorganize when they carry accumulated losses, face overcapitalization, or hold overvalued fictitious assets. This comparison matrix breaks down the mechanisms of corporate restructuring. Amalgamation occurs when two or more existing companies wind up and combine to form one entirely new company. In an absorption, one existing company takes over the business of another existing company. No new entity is created. During external reconstruction, one existing company winds up and a single newly formed company is created specifically to take over its business. In internal reconstruction, the company does not wind up. Instead, it undergoes an internal balance sheet overhaul to write off fictitious assets while keeping its original entity intact. Warning tone. Misidentifying the structure of the deal leads to the wrong Accounting Standard 14 method, such as applying the pooling of interests method when the purchase method is required. Converting a foreign branch's trial balance into Indian currency requires splitting items into two categories. This T-account diagram separates them into monetary and non-monetary items. Monetary items, such as cash and debtors, are translated using the closing exchange rate on the balance sheet date. Non-monetary items carried at historical cost, like tangible fixed assets, must be translated using the exchange rate that existed on the date the asset was purchased. Consider an asset purchased when $1 equaled 70 rupees. Today, the closing rate is $1 to 82 rupees. Which rate applies? Using the 82 rupee closing rate incorrectly inflates the asset's value. To accurately preserve the cost basis, the historical 70 rupee rate is required. In the final presentation, Schedule III requires every item on the face of the balance sheet to be cross-referenced to the notes to accounts to prevent over-aggregation. This cheat sheet summarizes the three structural rules: Schedule III thresholds for rounding, entity counts for restructuring categories, and item types for foreign translation. Mastering these theoretical definitions ensures your baseline marks are secured before you begin the first calculation. This foundation allows you to focus your mental energy on the complex computations required on exam day.